You might have heard of the devastating global chip shortage that is threatening to bring the tech manufacturing industry to its knees. But that's only one aspect of a much bigger problem. We may finally be emerging from the devastating shackles of the COVID-19 pandemic, but the wear and tear that it brought on the world economy have left cracks that are proving immensely difficult to repair. One of such cracks is the global supply chain conundrum that threatens to throw the upcoming Christmas holiday season into chaos. It's the end of the year. Families and individuals are more buoyant than they were 12 months ago when it seemed like the world was coming to an end. We are in the shopping season, but this time, a devastating global supply chain breakdown poses a problem no one could have anticipated. Why is this likely to happen? Well, it all has to do with the logistics surrounding this box, the world-renowned 40-meter-long container. On average, there are about 25 million standardized containers aboard an estimated 6,000 cargo vessels, all sailing to different destinations across the globe. They are part of a very fragile transportation network that must always maintain a balance between port capacity, railroad lines, and trucking networks. For decades, this network has been ever so reliable, resulting in super efficient just-in-time inventory management. While doing so, it has also lifted millions out of poverty, establishing a thriving industry that has made the world a much smaller and better connected place. But this well-oiled machine began to break during the COVID-19 crisis. First, there was an unpredictable demand for goods. This wasn't helped by the incessant lockdowns that meant that busy ports were practically shut down for several days, completely disrupting the balance of the network I spoke about earlier. The result of this was that container handlers struggled to manage traffic, and the on and off periods of activity meant that containers were also in short supply when they were needed the most. 1 year after the lockdown, ports and logistics companies are still yet to come to terms with the disruption in the industry due to the pandemic. As a result, ocean cargo rates are now 10 times higher than they were months ago as handlers struggled to meet up with the shipping demands. To understand exactly how things got to this point, we must take a closer look at the situation of things during the pandemic across the world's most popular trade routes. The outbreak of the pandemic began in Wuhan, China, and for the first few months the country was in peril. However, as the virus spread to other regions of the world, China gradually managed to put a lid over the situation. They were one of the very first countries to recover from the pandemic, and this had an implication on the movement of goods across the globe. For manufacturers to catch up with increasing demands, many more containers were sent all the way to China to retrieve goods. However, when they arrived in ports across the United States, these containers were faced with a devastating bottleneck. The ports were clogged as stores tried to scramble around to meet soaring demands. With a backlog of containers stuck at the country's busiest ports, truck drivers were overworked as the trucking system simply couldn't cope with the logistics demands. Both dock workers and truck drivers began to call in sick, leading to an acute shortage in workers, which only worsened the problem. By the start of 2021, the disruption had already spread to other parts of the globe, but things were about to get even worse. In March 2021, for about a week, the ever-busy Suez Canal was blocked no thanks to the grounding of a giant vessel along the canal. This only strained the already fragile shipping network. A burning question that has often been asked is, why didn't the shipping industry simply adapt to the demands? To answer that question, we'll have to rewind the clock. In 2017, about 12 container lines, which make up 80% of the global market, came together to form 3 major alliances. So the shipping industry was practically controlled by these 3 alliances. With the pandemic in full swing, manufacturers were suffering from severe part shortages and rising costs of raw materials. This forced them to put aside their pre-signed long-term shipping contracts and enter a bidding war for cargo space on ships in order to meet up with demands. The consequence of this was that shipping rates shot through the roof. As a result of this, the major carriers enjoyed some of their most profitable periods yet. For example, Maersk, the world's largest container line, made some of the largest profits during this period according to market analysts. It is estimated that in 2021 alone, the shipping industry will see incredibly high revenues of up to $100 billion. In the end, it all came down to business. While manufacturers and retailers struggled to meet demands because of the gridlock on shipping routes, the shipping companies, rather than working to speed up logistics, seize their opportunity to increase profits. This might sound like an inhumane line of action on the part of the shipping companies, but as I'm sure they'll be telling themselves, it was just business. To illustrate how ruthless the practices of these container lines are, there are reports of carriers returning to Asia from the US with empty containers instead of waiting for them to be filled with American export goods. The shipping lines do this to maximize the highly profitable eastbound shipping route. But try as they may, national shipping regulators like the FMC in the US can only do so much. Unfortunately, the global nature of container shipping is such that national regulators have limited control over shipping companies, and because of this, it's not likely that these regulators will be successful in controlling shipping fees. Back to retailers and manufacturers now. The current global supply chain chaos shows no signs of abating anytime soon. Retailers and manufacturers are well aware of this and have taken a survival of the fittest approach to this debacle to avoid incurring losses. Amidst the panic and the fear of shortages in the upcoming holiday period, manufacturers and retailers are over-ordering to compensate for the anticipated high demands this festive season. Unfortunately, according to Jonathan Savor, the CEO of supply chain technology firm Quincus, this approach by retailers will only make matters worse. Overstocking will add more pressure on an already overstressed global supply chain. Worse still, it could all come back to bite retailers in the butt, as distorted demand forecasts could result in unfulfilled orders because in the end, as demand increases from consumer to retailer and to manufacturer, the raw material suppliers will feel the most pressure to deliver. It seems almost inevitable that at some point these suppliers will be unable to fulfill their overbearing orders. On the larger scale of things, this supply chain disruption is bound to affect economic growth just when the global economy is gearing to emerge from the pandemic. Recently, the IMF downgraded its 2021 US growth forecast by 1 percentage point, citing supply chain disruptions and weakening consumption as the primary reason for this. So the big question is, when is this all going to end? The answer is very frustrating. No one knows for sure when the shortage will eventually plateau or normalize. Previously, most analysts believed this crisis would be resolved by mid-October. Obviously, that did not happen. But JP Morgan Chase's CEO, Jamie Dimon, has some encouraging news. In his opinion, we are just about to experience the worst part of the supply chain crisis. He believes that soon the market will adjust and this will no longer be an issue next year at all. Yes, that is a lot of optimism, but we sure hope his prediction will be spot on. On that note, we've come to the end of this video. I hope you've enjoyed it. If you have, please give this video a thumbs up and subscribe to the channel. Goodbye, and see you next time.